In this video, we're going to talk about the different real estate rules of thumb when analyzing investment properties. So these are different financial analysis ratios and multiples that investors quickly use to, multiply numbers by, or, looking at different ratios of numbers, and that can quickly give them an idea of whether a real estate's a good investment or not. So I'm Nick Foy, the founder of under30wealth.com, where I share mostly real estate investing lessons, but it is a personal finance website. You can find more on budgeting, stock market investing, growing your net worth, and it's designed for millennials and those in their 20s. That's why it's called Under 30 Wealth. I wanted to start it in college and document my journey of my 20s when I'm investing in real estate and growing my net worth. And I wanted to share lots of tips with others in their 20s to help them manage their money and build wealth. So if you haven't been to under30wealth.com before, it'd be cool if you checked it out. I think you're going to find a lot of value on the articles that are published over there. I also have the YouTube channel, Nick Foy TV, and the podcast, so you can learn more if you like visual or audio types of content. So back to today's lesson, where we're getting into the rules of thumb, financial analysis, ratios, and multiples. So we're going to go ahead and scroll down to the 50% rule, which is rule number 1. And the 50% rule stands for how to analyze like a rental property if you're trying to figure out if you have enough rental income to cover all the expenses and the mortgage. So the rule states that for a real estate investment, you want the non-mortgage expenses to average about 50% of the rent long term. So this is kind of just a rule. So when you're analyzing, all the different expenses going out of a property, you can expect it's going to be about 50% of the rental income. So that's going to tell you that you're going to have about 50% left, which is then going to be used to cover your mortgage payment. So if your mortgage payment makes up more than 50% of your rental income you're going to be bringing in, it's probably going to be a risky deal where you potentially could have negative cash flow. So it's a rule of thumb just to kind of help screen out some properties that might have some cash flow problems in simple terms. So let's do an example. Let's say you own an 8-unit building and it brings in $5,000 a month between those 8 units. So that's roughly, maybe $600, $650 a month in rents. Now I know if you're in a different market like an expensive Los Angeles or DC or Miami, rents are never going to be, $600 and some dollars per month per tenant. It's more like the Midwest. You can find, rental units these days that are still in the $600, $700s per month. So let's just use it as a fake example, $5,000 a month in rent. And then you can expect, using the 50% rule, that probably about $2,500 a month of that's going to go towards different expenses. So you've got vacancy expenses, you've got maintenance, you've got other non-mortgage charges, so property taxes you got to budget for, property insurance, your portion of utilities you're responsible for, like if you've got lighting for the parking lot, or water and sewer to the water company in the city. So there's different landlord responsible expenses you have to pay, and you can expect them to be about half of the rent. All right, so again, the purpose of this rule is just to ensure that you leave yourself 50% of the income after all your non-mortgage expenses, so that remaining 50% can go towards covering the mortgage debt payments. So if you find out, again, that your mortgage payment's going to be more than 50% of your gross income you're bringing in from the rental property, then it's advised not to purchase that property. Rule of thumb number 2, the 2% rule. So we've got a whole other video on this rule, but we're going to cover it again briefly here. So the rule of thumb for this is that your rental income should be about 2% of the purchase value of your property. So this gives you an idea of what to try to offer on a property when you're going in to make the purchase. It doesn't work if you're going to analyze the actual property value or the actual comps of the neighborhood. It's a lot harder to find 2% in that term. What we're talking about is like your purchase price that you're taking over the property for. So in the example, if you had a $50,000 property for sale, and you're going to run the 2% rule, that means that rents should be about $1,000 a month, as $1,000 would be 2% of that $50,000 property value of the property. All right, so that would be 2% of the purchase price that you're bringing in as monthly rent. So that's what this rule is. Now, on the flip side, when we talked about analyzing what you should offer on a property, typically you're not going to be able to just rent a property for whatever you want. So if you buy a $50,000 property, you can't turn around and say, all right, I'm going to rent it for 2% and rent it for $1,000. That doesn't work. Instead, it works on the reverse. You have to go by what the market is paying for rent. So that's where you got to start with the rents first. So if you look around the neighborhood and you see that properties are renting for $1,000, then you could turn around and use the 2% rule to figure out what the max you would pay for the property would be. So you would divide that $1,000 of rent per month, that figure that you come up with, you divide that by the 2%, or you could just multiply it by 50 since, 2% is 1/50th of 100. So if you think about ratios and math there, so you're either going to multiply the rent by 50, saying that you're going to pay 50 times the monthly rent for the property, or you're going to have to divide that rent by 2%. Either way, it's the same thing. It's going to come out that you're going to pay $50,000 to acquire a property that rents out for $1,000 a month. So knowing the 2% rule, you can apply that to different rents. So if in your market, the rent's $500 a month, then, you do that same ratio and you're going to get $25,000 is the purchase price you'd want to offer in order to buy the property so that it works out as a 2% rule. If it's, if your rents are $2,000 a month, like maybe in California, people are paying $2,000 a month for rent. Now the 2% rule would work to say, $100,000 is the property value you'd want to buy. Typically, the 2% rule is only going to work though in smaller markets where you can still find properties at distressed prices that are $25,000, $30,000, $50,000, $100,000 maybe. When you get into big markets like California, it's hard to find where this 2% rule works out. That's just a nature of the game. Different markets have different property values versus rent ratios. California, they pay way higher ratios for smaller rents than the Midwest. In the Midwest, you can find a valued property that's not that big of a multiple. So in other words, the $50,000 purchase price when it's renting for $1,000, that's a 50 multiple of what the monthly rent is. If you were to multiply it, on an annual basis, so $1,000 times 12, you're going to look at $12,000 a year. So you're buying the property for $50,000 and you're expecting to collect $12,000 a year in rent. So you just bought the property at an annual multiple of about a 4, because you could multiply 12,000 by 4. So in other words, in 4 years, you're going to have recouped your investment. So in 4 years, you've now made back $48,000 in gross rents, probably $50,000 because you're going to raise rents each year. But that's basically what these different multiples do. You have a monthly multiple and you have an annual multiple. It's known as the GRM, the gross rent multiple. So in California, they have high gross rent multiples. So people are willing to pay, 30 times, 20 times the annual gross income, whereas the example I just did, you're paying 4 times the gross rent. So if you're getting $12,000 a year in rental income from a property, you're only willing to pay about a 4 gross rent multiple for it. You're paying $50,000, that's about 4 times. But in California, they're willing to pay more like 10, 20, 30 times. So they're willing to pay $150,000 to $300,000 to buy a property that's going to bring them $12,000 in rent. So if that all makes sense, you can kind of see more why this rule is effective. You have to use it differently in different markets. And in California, you might use like the 1% rule where rents have to be 1% of the purchase price, where in the Midwest, you could get more deals that follow the 2% rule. So an example, just to show you that it does work, when we bought our first property when I was in college, we bought it for $30,000 and it rented for $925 a month. So if you want to do the math there, you take the $925 and then you just multiply that by 12 months. So we could collect a total potential gross rent out of the property of $11,100. So $11,100, and again, we're collecting, we only paid $30,000 for this property. So when you want to divide $30,000 against the $11,000 we collect in rent, we almost are paying a 3 multiple. So that's definitely going to, work in our favor, because you saw the 2% rule is about a 4 multiple if you're trying to do quick math. So if you're buying at a 3 multiple, then you're definitely buying at a higher than 2% ratio. So we could just run the math though. You take the $925 a month rent, divide it by our $30,000 purchase price. So we bought it at a 3.1% ratio. So that meets the 2% rule. We were above it, so that's good. If it's below it, that's not good. If there's other properties out there that are above it, so that's one of the quick rules you can use if you're screening, 10, 20 different properties. Just take a look at all the different, rent to purchase ratios and see which one's got the best, the highest percentage. However, just because it has the highest doesn't always mean it's the best property. It might need a ton of work. In our case, we bought a property that was distressed. It wasn't its true market value. Its true market value was $120,000. So if you divided $925 rent by the $120,000, end sale value that we sold it for, the market value of the neighborhood, it would have came in at less than 1%. So that's why this rule is based on purchase price, not actual value of the property. Because when you're buying an investment property, you're already buying it at a discount to its true market value anyways, because the odds are you want to fix it up and you want to resell it for a profit. So that's where we're saying that you want to make the purchase offer on the property at something that's around a 2% rule, that suffices for the 2% rule. That's how you know you're going to be getting in at a cheap enough price that you're going to build in some profit if you try to flip the property, and it's going to allow you to get in at a cheap enough price that you're not going to have a big monthly mortgage payment, because the higher you pay for the property, the more you're going to have to take out as a loan, and the more interest and the larger your mortgage payment, the less cash flow your rental property is going to have. So that's the other reason why going in at a low multiple is going to be best, because it's going to save you, that big mortgage payment, and you're going to have more cash flow. All right, I feel like I exhausted the 2% rule there. I took a little longer, but it's a difficult rule to understand and wrap your head around. So if you're still confused, do some further research, but I hope I made it simple that you're just checking the rent against the purchase value, and you want to buy at 2%. So the rent's only 2% of the purchase value. You don't want it to be less than that. You want it to be more than 2% if possible. Rule number 3, the 70% rule is for flips. You want to buy a property so that your purchase and repairs all-in cost is about 70% of the final value. So our example again, buying a $30,000 house that could sell for $120,000. If we were to do the math there and figure out what our all-in cost needed to be, we'd multiply that final repair value by 70% to figure out what our all-in needs to be. So let's take $120,000 and we're going to multiply that by 70%, and that's going to come out with $84,000. So our all-in cost, meaning purchase price, renovations, all our costs during the renovation and the flip, needs to be $84,000 or less to follow the 70% rule. So that's going to leave us a 30% potential profit margin before we take into effect, we're going to have closing costs and commissions on the backside. So when we sell, we're going to have our real estate agent fee we got to pay. We got closing company, title fees and closing costs to the title company. So that's going to eat away some of that 30% profit margin, but we're still going to come out with a profit. So in this case, $120,000 is our resale. If our all-in costs meet the 70% rule of $84,000, we have a potential to make $36,000 of profit before we take out the realtor commission, closing costs, etc. So in our case, we bought it for $30,000, so that was our purchase price. We only put $15,000 into it, so we were all in for $45,000, which was well under that $84,000 threshold if we were trying to abide by the 70% rule. So we met that rule just fine. We left ourselves a fat profit. Like I said, we ended up making, when we resold at 120 and we were all in for 45, we ended up making almost 75,000 in profit there. And then, we rented it for a year and a half or so. So we ended up making some rental income on the property. And then when we sold it, we had a loan out on it. So we made some interest on the loan. So it ended up being a 6-figure deal over the time span of a couple of years on that first deal. But it all was because we followed these different rules. We met the 70% rule, we met the 2% rule, and we met the 50% rule. We looked at our monthly expenses on the property, and we had enough room that we were able to make, all the cash flow work out where we met the 50% rule. But we didn't even get a mortgage on it, so, we were able to pocket that additional 50% or more. Whatever our expenses were, we were able to pocket everything else as net income after that because we had no debt on the property. All right, so that's it for this video. Those are the main rules of thumb to follow, the 70%, 50%, and 2% rules that apply to rental properties and purchase prices and flipping houses, knowing the 70% of the ARV, the after repair value. Lastly, let's talk briefly again about the gross rent multiple. So this is just looking at how much you're going to buy the property for relative to how much gross rents you're going to acquire. So if you think about 5 different properties out there, one could be selling for $100,000, one could be selling for $200,000, one could be selling for $175,000. So they could have different prices on them, and in order to compare apples to apples, you can use the gross rent multiple to see, all right, if I buy this house, here's how much I'm paying, here's how much rental income I'm getting back in return, and then if I buy the second house, here's how much I'm paying, here's how much rental income I'm getting back in return. And the one that's got, the lower rent multiple means that you're paying less to buy that stream of cash flow. So the less you pay, the better. You're going to get a better return on your investment. So you can compare multiple properties by looking at the gross rent multiplier. The operating expense ratio. This compares expenses of the overall property, so your expense versus income. So ideally, we talked about the 50% rule. You want your expenses to be less than 50% of the income you're bringing in. So that's what the operating expense ratio is in other terms. It's basically the 50% rule. You're just looking at, what percentage are my expenses of my income. If you find a property that's in the 30 to 35% range, meaning for every $10,000 of rental income you bring in, you're going to spend about $3,000 to $3,500 towards operating expenses for that property. That's ideal, but most distressed properties, when you first take them over, if you're buying, a beat up property or a poorly managed property, you're going to look at what they were bringing in rents, you're going to look at what they were spending, and you're going to see a higher operating expense ratio. So this is going to be, closer to 50-60% on the buy side. But when you go to sell it, you want to improve that. You want to get expenses down, you want to get rents up, and that's going to take that ratio down lower, back down around that 30-35% sweet spot, which is ideal when you go to sell. That's going to help you get a better value on the property when people are valuing it, and you're going to get a higher, offer from a buyer, and you're going to make more money on the flip. The break-even ratio, so this is the number of months the property needs to be rented to collect enough income to cover your operating expenses. So if you're trying to plan out how long a property could sit vacant and you could still break even on the property, this is the break-even ratio. So if you're typically bringing in $1,000 a month in rent, you're going to make about $12,000 a year if it's fully occupied all 12 months. But maybe your expenses for the year are about 50% of that. So you're spending about $6,000 in operating expenses on taxes, insurance, maintenance, all that stuff. So you got to have a break-even rate of about 6 months. So that tells you the break-even ratio there, that it's 0.5. So the property needs to sit, occupied at least half the year to break even. And then lastly, the debt service coverage ratio. This is what the banks will use if they're analyzing cash flow of a building when looking at if it can cover loan payments. So they want to see that, the income on the property against the debt is at a healthy ratio. So they typically look at 1.25 as the ideal debt service coverage ratio. So for example, you have an investment property, again, producing $10,000 a year in rents. You got $5,000 in operating expenses. So you're left with a net income before your debt, about $5,000. Now let's say you have payments on that property for debt. So you took out a mortgage, and let's say those mortgage payments come out to about $3,000. So you're spending, $5,000 on operating expenses, and then you've got $5,000 left in net income before debt to cover the $3,000 of debt. So they're going to look at that net income of $5,000 as a ratio against that $3,000 in debt payments. So in that case, divide 5 by 3, and you're going to get 1.67. So that's the debt coverage ratio of the property. So 1.67 is, above their recommended level of 1.25. So that's a good thing. If it was about break even, meaning you were only net income about $3,000 after all expenses. So again, you bring in $10,000 in rent, you spend $7,000 on operating expenses. Now you're only cash flowing $3,000 before debt, and your debt is $3,000. That would be a 1-to-1 ratio. Your net income before debt would be equal to your debt payment. So you'd be having zero cash flow, zero, after debt income on the property, and that's not ideal. So that's why banks want at least a 1.25 ratio, so that gives a little bit of a buffer so that you're still making some net profit after you make your debt payments, and that covers you as well so that you can make sure you're not going to default on your debt. All right, guys, that's it for this video. We covered the 3 different financial rules of thumb, the 50% rule, which looks at operating expenses so that you can leave yourself enough to cover your debt. We looked at the 2% rule, which makes sure that you're not overpaying for a property if you're trying to buy it cheap and have it cash flow nicely. You try to buy it at about where the rents are 2% of the purchase price. And then we looked at the 70% rule, which is the 70% ARV. And then we talked about the different ratios. So the gross rent multiplier, the operating expense ratio, the break-even ratio, and the debt service coverage ratio. Yo, check this out. So if you type in asknickfoy.teachable.com, asknickfoy.teachable.com, when you hit enter, it's going to open up my resource library. So I've been working on tons of training video modules, and I put them together in these different courses. And you can go over here to asknickfoy.teachable.com, and you can learn how to start a website that makes money. So this is called Profitable Blogger. You can also learn how to make money from social media like Pinterest. You can also learn real estate investing. So these are 3 ways I currently make money right now. I'm making $6,000 to $7,000 a month. I've already come out with a video showing you how I was making $1,400 a week a little while back, and we're on pace to eventually get to $10K a month passive income through websites, through social media, and through real estate investing. So these 3 methods combined, I created these 3 training courses. You can go here to asknickfoy.teachable.com to check them out, and I look forward to seeing you guys on the inside when you enroll in them. Yo, before you go, make sure you are subscribed to the channel, Nick Foy TV. If you hover the lower right corner of your video right now, you're gonna see the little red subscribe button. When you hover that, it's gonna pop up that subscribe button, and it would mean a lot. I already appreciate you gave me your time, your attention today, but if you could also hit that subscribe button, support the channel, and smash the like button, as they all say in every YouTube video. So smash the like button, hit subscribe, and I'll see you guys in the next video.